Have you ever felt that gut punch moment when you realize that you missed out on something big because you weren't paying attention?
Yeah, Chris, I can think of a few times, especially when it comes to investing. You spend your time working, saving, and really trying to learn how to do things the right way, but somehow you still feel like you're left behind.
I know, right? And we're all told stuff about investing. You need to be a genius. You need to have the right time in the market. Or you just need to have the right insider knowledge. But let's be real. What if all of that advice was just noise to keep you confused?
What if there was a simpler way? What if there was a way that actually works for the everyday person who's just trying to get ahead and not complicate things?
Well, you're in luck because in today's podcast, we're cutting through the noise and we're breaking down 11 real actionable investing lessons that we've seen actually work for people. Not the hype, not the shortcuts, just stuff that gets the real results that you're looking for.
If you take these lessons to heart, you're going to walk away with a game plan that doesn't just make sense, it makes dollars. So if you're ready to stop spinning your wheels, grab a pen and get ready to take some notes on today's episode.
We're here to help you cut through the noise of confusion and take control of your financial future. This is the Fi Guys. Let's dive into it. In today's episode, we are breaking down 11 lessons every investor needs to know and 11 lessons that actually work. Because I find there's a lot of people out there giving out advice, quote unquote, advice with all of their tips, all their tricks. And at the end of the day, none of it really means anything. So hopefully with our 11 lessons today that we wrote down, we'll be able to really help you supercharge your way to growing your wealth. And with that being said, let's start out with number 1. You don't need to be a genius to build wealth. In fact, most millionaires in America aren't doctors, they aren't CEOs, they're teachers, plumbers, and small business owners who invested consistently over decades. In fact, 79% of millionaires didn't inherit a dime from anybody. They just followed a simple plan and stuck with it.
Yeah, let's be honest. Wealth building, it's not as complex as we think. It's actually very simple, right, Chris? It's about consistency and time in the market, right?
Yeah, simplicity and consistency beats complexity and genius most of the time.
Keyword most of the time. I know there's always those outliers where it's like, well, if this guy did it and he has $1 billion company, it's like, no. We're talking about regular people here. We're talking about average Joes, you and me, So let's keep it in that scope. So you don't need to be a genius to build wealth. Thank goodness. Not a genius. So there's still a chance for me, and there's still a chance for you, listener, unless you're a genius. I don't know your life. Let us know in the comments. Are you a genius, Chris? Did you develop these strategies yourself? Where did you come about with these?
With these strategies, these 11 right now? No, these are just things that I've brought up and learned over the past decade of investing and teaching people how to be better investors. But what I've always found is that when I talk to people about, why don't you invest? Why are you trying not to grow your wealth? They always say, oh, well, I don't have that knowledge. I can't learn that knowledge. That's some sort of secret knowledge that's out there that you have to probably invest 20, 30, 40 years of your life to be able to even to start to invest, to start to grow your net worth, to try to purchase some sort of an equity or something that actually gives you value. Too many people, they go through life looking for a way to build their equity, to build something to purchase an asset. And they think before I purchase that asset, I need to have all the knowledge in the world. And then they go out and they're like, but I can buy a house without having any knowledge. So I always think there's a funny conundrum in there that I want to just bring to people's attention. You do not need to be a genius to build wealth.
And I think that's one of the funny things about being successful, being wealthy, being rich in this country. There's a lot of people, and I mean with no disrespect, but there's a lot of people dumber than you, richer than you. Just think about that. Let that sink in, right? There's people that have a life that you want that aren't as bright as you, that don't have the advantages that you have, right? Let that sink in. So if they could do it, hey, you can do it too. You just got to figure out what those things are kind of holding you back, address them, attack them, and get over them. Right, Chris?
Yeah, 100% agree with it. Majority of the time that people, the biggest thing that stops somebody from being successful is themselves. It's them holding themselves back because of their beliefs that they can't succeed. So without even trying, they hamstring themselves before they even begin the journey because they are afraid to start and maybe fail at something. So what you learn from that is that majority of the constructs in life are built up in your own mind. There isn't somebody actually out there stopping you, holding you back from achieving whatever it is that you want to achieve, with the exception of yourself.
And that's something that we got to carry with us day to day, right? But let's get on to the next point, because I know you're hungry, I'm hungry, the audience is hungry to learn more about what these 11 lessons are. So let's continue.
Yep. Lesson number 2, trying to time the market is a losing game. In fact, if you missed out on the top 10 best days over the last 20 years in the S&P 500, well, you would have seen your returns cut in half.
Ooh, man, that's a tough pill to swallow. That's a really tough pill to swallow. But I'm kind of curious, Chris, at what point do you sell then? At what point? I know obviously sometimes the hardest decision is to like when to get in, right? But another decision is like, well, when do you get out, right? Is it when I retire, when I die? Is it like XYZ? You know, is that why people need a financial advisor like you?
I wouldn't say that everyone needs a financial advisor, certainly not. But as you get closer to that end date, when you're going to start pulling on that money, that's when things get very complicated. Too many people say, oh, if I just looking in hindsight, if I bought on this day and sold on this day, then everything would have worked out. And that's all well and good in hindsight. It's very difficult to choose the days in which you know I want to buy on these days. It's even more difficult to choose what days I'm going to sell on. So in order to create that, since that is known as sequence of return risk, at what point do we start pulling out of our returns, and how does that hurt us in the long terms of being able to make sure that our money lasts however long we need to? That's just something that's extremely difficult. And I can't give you that answer right here on this podcast because that's specific advice. And I need to make sure that I keep myself regulated by that. So that's the time where you need to talk to somebody that's professional, or you need to feel it out for yourself. Typically, if you're about 5-10 years away from retiring, you want to start to move your money away from those equities, from those quote unquote volatile investments, and start moving them over to some safer investments, because you know that you're going to need that money in retirement. Or you just continue working on. Of course, there's a bunch of other options you can choose from, but it's always difficult.
You said earlier, you know, when you get closer to that end date, right, you should probably, you know, start talking with a financial planner advisor, you know, something like that. When you say that end date, are you talking death or are we talking retirement? I just want to make sure.
Yeah, we're talking about retirement.
Okay,
if you knew your death date, then it'd probably make it a lot easier to make a financial plan, but no one knows what that day is going to be.
I mean, I'm going to push back on you real quick. I mean, you can take it into your own hands, be like, hey, February 6th, 2070, that's the day. I'm going to burn everything till then. You know, we choose to live, you know, why not choose to die too? That's kind of dark, actually. It's kind of dark, very dark, but that's what we're here for. The dark truth of finance. All right, we're going to get back on track. We're going to get back on topic. So number 2 is trying to time the market is a losing game. Like we said in the intro, we've said this in a few shorts and many podcasts. The best time to plant a tree was about 20 years ago, to be honest, right? But the next best time is today. And you know, I'm not just talking about planting trees, right? I'm talking about investing here. Okay? Stick with me.
So if you're trying to time the market, you are playing a losing game. From 2002 to 2022, a 20-year span, if you missed just 10 days in the market, your returns would have gone from 9.8% compounded over those years to 5.6%. That's nearly half by missing only 10 days. So, Dominic, if I grabbed a random calendar, 365 days, and I said, choose the 10 days you want to be invested to get all the gains.
Yeah. I would push back because I'm a mean commenter. I'm a troll in the comments. Well, the stock market isn't open 365 days, Chris. And you know what I'd say? Bam, slap me down. Slap me down because I'm a mean troll in the comments. Yes, we know the market isn't open 365, right? I would not be able to pick which day is going to be the best day. There's no way. I could never pick that. I am lucky. I'm not that lucky.
Yeah, it's like only trying to show up to work on the days that everyone is being the most productive days. It's impossible to predict. Yeah. So you just have to keep on showing up and hoping that this is going to be the day that everyone gets their stuff together.
That's kind of a funny analogy. I like that. Imagine if we could predict that. That'd be so great. That'd be so much better. Show up to work like once a week. So we've got number 1, you know, you don't need to be a genius to build wealth. Thank goodness for that. Number 2, trying Trying to time the market is a losing game, unfortunately. Number 3. What do we got for number 3, Chris?
Volatility isn't a bug, it's the price of admission. What I think a lot of people think about is when they see that the stock market on average returns somewhere between 8 and 10%, that means that you have to accept that there can be a negative 10% to a negative 30% swing sometimes. Too many people, they'll look at that volatility, the price going up and down, and they say like, oh no, there's something going wrong with my investments. It's moving up and down. Well, that is a fee to play the game. It's not a fine. I think if you think it like that way, if I'm driving at 50 miles an hour in a 50 mile an hour zone, that's just the way it is. My gas is going to continue to burn. Everything works like that. But when you start to play it as that, oh no, the volatility is now I'm getting fined for it, I'm in trouble. That's when people start to look at it the wrong way. But if you look at it, the volatility is just a feature. It's not a bug. It's a part of investing. It's the normal part of investing.
And I love that quote, temporary pain is the entry fee for long-term gain. Remember that, guys. Temporary pain is the entry fee for long-term gains. I love that. Okay, so that can be very difficult for some people. We talk a lot about on this podcast how, money is our life's energy, right? Not to be all woo-woo, all this and that, but it's true, right? You go to a job, you spend your time, you spend your energy, you get $1 or $2 and back in return, right? And you invest it. That's our life's energy going up 10, down 10%, right? So that volatility is, it's time, it's energy. I could have spent that with my kids, with my grandparents, with my, eating something delicious. I'm going to talk about food, boys. You know this. Every podcast we got to mention food. There's always a food reference. But how do you become seasoned enough to not let that affect you? And really, that's not just a finance thing, right? That's how do you not let your emotions control your actions? That's a podcast in itself, right? But Chris, any idea on how we can benefit from that?
How to not let your emotions get in the way when volatility is going up and down?
Yeah.
I think it would be taking a wider perspective and realize that you're getting better in something else. If you're only focused on the returns and you think that the returns are the only thing that matters, not focused on your savings rate, how much money you're making, how much money you're spending, and you're only focused on the returns, the only thing that matters, that's the only thing that's going to get me to be financially independent or not, you're setting yourself up for a harder life than you need to. I kind of think it's like going to jiu-jitsu. If you go to jiu-jitsu, you accept that you're going to get bruised along the way. But you also know that every time you roll, you're getting a little bit better. You don't get the long-term rewards without short-term discomfort. You have to learn to be okay not being okay.
It kind of reminds me of so many things in life, right? So many things in life. Just like Chris and you and I were at the gym earlier today. And, the lifts we were doing towards the end, right? Quite painful, right? It was tough. It was tough to push through. But the best things in life are usually painful, right? We get the reward, like we get to show up the podcast. I had to buy a bigger lens just to house me because, I'm just so wide. I'm like a mini Jay. I would never say I'm a mini Jay Cutler. That's disrespectful to Jay Cutler. We love Jay Cutler. But, it's those things that if it's difficult, right? If it's challenging, you're in the right place, man. You're in the right place. If Chris and I went to the gym and we did 5 pounds or 5 reps and we didn't even break a sweat, well, we're not going to get better. It's sometimes the pain of admission, right? That's what you want. And in a really sick way, and I know this is going to sound sadistic. This is going to sound, masochist in a way, but the pain is good. The pain is vindication that progress is coming, right? But it's all about how you look at the pain. It's all about how you frame the situation, life, whatever's happening to you. If you can change the frame, you can change the vision, you can change how you feel. And I honestly, life changes when you can change the frame. And I hope that makes sense to you. Did that make sense, Chris?
No, it does. I would always say it's a wider perspective, changing the frame, the same exact thing. You just need to look at it a different way. I'd like to move on to number 4, if you don't mind. Number 4, I think, is one of those ones that when you hear it, you're going to be like, well, that's stupid. But it's probably one of the more profound ones. It's that boring in investing is beautiful. Someone who invests just $500 a month into something like the S&P 500, the S&P 500 could be a proxy for really any low-cost index fund from the ages of 25 to 65, well, they'll end up a multimillionaire, assuming an 8% return. That doesn't mean they had to get any crypto, any options, any day trading. Nothing had to be sexy. They just stuck with a boring plan, and they stayed consistent for decades and decades and decades. And they were able to beat, on average, the Wall Street guys, the crypto guys, the options guys, the day traders. Yeah, every so often along the way, the day traders could have said, this is our day in the sun. Like, we're beating everybody. And they would be right occasionally. But the way to be consistent, there is a simple path to wealth in which you just have to do nothing but be extremely boring and consistent for a long amount of time. It's like cooking with the same 3 ingredients. It's not flashy, but it works. Chicken, broccoli, rice. Simple, and it works every single time. If it feels exciting, it's probably not sustainable. You know, Dominic, we talked earlier about going to the gym, right?
Yeah.
You and I went to the gym. We did some pretty simple lifts, right? There was never a time where I'm like, all right, Dominic, in order for us to really get jacked, I need to throw this kettlebell at you. You need to catch it with your left hand and then throw it to your foot and then throw it back up and, you know, catch it with your head and then do 6 snatches and a backflip. Yeah, I've never told you to do any of those things. It's the simple things repeated over and over and over again that get you to look like Kai Green, Jay Cutler, Arnold Schwarzenegger. It's doing the exact same things over and over and over again. Boring is beautiful.
Yeah. You know, in order to get that high level of success, it really is just about simplifying things and consistency. The most complex systems, what is it? Complexity kills progress.
Yeah.
You know,
you know the enemy
quote.
of progress.
Yeah, exactly. I love this. I don't know who said it, but I always love this, right? When coming up with a plan, and I love plans, but I've learned that sometimes plans are an enemy as well, right? I get caught up too much in the planning, but a good plan, a good idea, if it can be explained to a 5-year-old and them understand it and they can tell it to you back and understand it, well, that's a good plan, right? That's a good plan. So that's kind of what you should shoot for when it comes to finance and investing, right? We're going to invest this much at this time consistently. And then at this time, we're going to get out, right? Simple. It's simple, right? When we start getting into, let's do a little bit of crypto over here and a little bit of, IPOs over here and a little bit of day trading over there. It's like, sometimes you got to pick one and go all in on just one. And I'm not saying day trading.
So number 4 was boring is beautiful. Number 11 of investing tips that everyone needs to know is number 5, compound interest needs time to work. If you invested $10,000 at the age of 21 and it grows to be $160,000 by the age of 65 with no extra contributions, all you have to do is just wait. You literally just have to put money in and wait. Compound interest takes time. Unfortunately, it's hard for us to understand as humans because we think logarithmically, meaning 1, 2, 3, 4, where when you think about exponential growth, 1 to 2, 2 to 4, 4 to 8, 8 to 16, 16 to 32, and go on and so forth, there's a point in which that investing elbow turns. If you think about Warren Buffett, if you look at his past returns, he's not that great of an investor overall. His returns compared to the market are slightly above average. There are better investors out there who have substantially better returns. What they don't have when it comes to Warren Buffett is his 97 years of investing. Majority of Warren Buffett's wealth, had he stopped at 65 when the average person does, we would never hear about him. He would just be a normal guy. It's because he had an additional 30 years on every other investor because he's been going since basically he was a kid until now. He has almost 100 years of investing. And that is what makes him the GOAT, is that he is the turtle in all of this. He allowed compounding interest to go, and he just got the hell out of the way.
It's like that interesting study you told me a couple of weeks back. I think we mentioned it on the podcast, but I think it was like Fidelity or one of those brokers. Yep. They were saying that the best accounts for returns on investment were people who had died and the money was like never collected. So basically, they got out of the way in a pretty dark way. But that's the best way. I mean, oftentimes we get in the way of ourselves. We self-sabotage because we lack the impulse control, we lack the emotional control, or we think our knowledge is better than, something else, right? And that's tough. That's really tough, but that's why the power of compounded interest is so important, right, Chris?
Yeah, it comes down to time is far more powerful than timing. You can't time the market. So time in the market is the only way you can beat that. And then also, the sooner you start, the less you have to do later because of that power of compound interest. If someone who saved $100,000 or even saved $10,000 at 20 and let that just ride is better than the person who starts trying to save $100,000 at 60, just because the way that money continues to move. And isn't it such a nice thing that you can invest in something? Again, boring is beautiful. You can invest in something like a low cost index, and you know that you have some of the greatest minds, greatest capital allocators in the world working 24/7 for you to try to get you the best returns that they possibly can. That's pretty cool.
Thing. Yeah, that is pretty cool. That is pretty cool. So that was number 5, correct?
Mm-hmm. And
we're
number 6.
Halfway.
We're halfway there. Yeah. Number 6, you will lose money sometimes. And that's okay. The S&P has fallen by 10% on average 2 times, or on average every 2 years, 10%. And yet we still have around a 10% per year return when you look at it over 100 years. So that means every 2 years, you're going to have a 10% drawdown. And somehow you still get a 10% return. That's part of it.
Interesting. I feel like that's not something we talk about a lot. The 10% drawdown. It's kind of an interesting concept.
Yeah. Losing money is normal. But what you can't do is you can't quit. You have to just continue to stick with it. And remember, this is the most important thing. You only lose money when you sell. Too often do people, they start to go high watermark. Whatever my highest amount was in my account, that's my new anchor. But they forget as to what they started at. So someone that puts in, I don't know, say $1,000, and that $1,000 goes to $2,000. Well, now they're saying, okay, $2,000 is my new base. So the moment it goes down to $1,800, well, now they're like, well, I just lost $200. It's like, well, you never had the other $1,000 that you had because you never sold.
No, and I think that's such a psychological thing, though. It's seeing it go down so much so quickly, and it's kind of funny. It's kind of like a meme in the financial community too. It's like, well, you only lose if you sell, right? You only win if you sell, and it's so tempting. But once you sell, you're out. So it's like, do you want to continue playing the game and for the chance to go up or go down, or pull out and you're fine where you are right now? And that's a scary game. It's would you say it's harder to buy, or would you say it's harder to sell, Chris? Or does that even come? It's harder to sell.
Yep, that's just my experience. It's substantially harder to sell than it is to buy. Buying's actually relatively easy, but getting out, that's hard because you never really know. Once you buy, also, you have a bias to say, like, I need to stay in this. So now you have biases because it's yours, which makes it just harder. Okay. But just know that when I say losing money, losing is in quotes, losing money is normal. But it's quitting. It's quitting investing that kills your returns.
Yeah. And that's tough. That's not something you want to say like on the first date of investing. Maybe. Or maybe you do. Maybe you just you lay it all out on the table. Like, hey, we're going to lose some money sometimes. Maybe that's more of the conversation we need to be having with people in finance. It's like, hey, sometimes we're going to lose. But the idea is most of the time we're going to win. We hope. Right? If you have the right plan in place. Right? So we talked a lot about, you're going to lose some money, time in the market, volatility, boring is beautiful, right? What do you have for the next? I'm tapped out. Like, I thought that's all the knowledge we have. What else could you be hiding in this mythical mind of Chris Ponson?
Number 7 of our 11 investing tips that you need to know is that diversification equals humility.
Explain that a little bit.
Well, diversification means you're always know that you're never going to be fully right. But that also means that you're never going to be fully wrong by spreading your eggs amongst enough baskets. By spreading your bets, one investment won't save you, but it also won't sink you. So by being able to diversify, you're able to tell the world, tell everyone, including yourself, that you only know so much and you can't have all knowledge.
Interesting. Do you think diversification is a problem in the finance community, or is it something that's kind of accepted now?
It is generally accepted to diversify.
Okay.
But if you're going online and you're trying to figure out what should I buy, you're never going to say, there aren't very many people telling you to diversify because everyone's trying to sell you something. To make the claim, oh, all you have to do is buy a low cost index fund and just get out of its way for a long time. Who makes money on that? No one makes money on that. Wall Street, society makes money on the buying and the trading. In 2020, tech crushed everything. In 2022, energy was the king. Nobody saw either coming. So what do? You buy an index fund, you stay out of the way. And then you know that no matter what happens, I don't know if it's going to be energy next, I don't know if it's going to be technology, AI, but whoever's winning is going to come to the top. And you benefit by getting the hell out of the way, by diversifying over a large enough asset base that you don't have to do anything, but just allow your winners to win and allow your losers to drop off. Diversification is difficult because it's not sexy. You can't go to the party and be like, guess what I'm invested in? The S&P 500 that everyone else is invested in. And yet you get to stay out of the way and win.
Yeah. I love that quote that, I don't know where I heard it. I think, hey, if it's a good quote, it's coming from Chris Monzon, right? That diversification means that you'll never strike it rich overnight, but you'll never go broke either. I mean, unless, right, the whole country is nuked and AI takes over and destroys us all. That's a different conversation, though. But I like that because a lot of times, man, people just want to play it safe. And I mean that in the best way possible. I mean that in the most amazing, like, that's a great option possible, right? There's nothing wrong with playing it safe. Diversification is safe. It's safe. And that's why it's such a good bet. That's why people buy indexes, right, Chris?
Yep. It's just
safety
get the hell out of the way. Just do it. Get out of the way. Again, is it safe? Safe is relative.
Self is
compared to what?
Fair enough.
So,
fair enough.
Number 8 of 11 investing tips that you need to know. Having a plan beats having an opinion. Oftentimes, the person who panics during the market drops is usually the one who does not have a plan. A plan could be as simple as I invest $100 into a broad market, low-cost index fund, and I rebalance once a year. I think the quote that I always like on this one is, you don't rise to the level of your motivation. You fall to the level of your systems. So if my system is, I have a plan. My plan is I do this every time. That way, when stuff goes wrong and now your opinions start to take over, you can tell your opinions. You can go away for right now. I have a plan. I'm sticking with it. Much easier said than done, but that's the reason that we need to write these things down and to, as Socrates said, know thyself before things get tough.
I love that systems quote you said. That came from James Clear, if I'm not mistaken, from the book Atomic Habits. And I think that's one of those books that is a must read for everybody. It's like one of the best personal development books, especially for just building a better person, building better habits, right? Because let's be honest, right? We talked a lot about consistency on today's podcast, right? If you can't be consistent with your habits, we're talking saving, we're talking investing, we're talking, being smart with your money, doing things the right way, then really you can't move on to diversification. You can't move on to compound interest, right? If we don't have some kind of a financial idea of what's going on, well, then we're not ready for this investing game, right? There's levels to it. You wouldn't ask a baby to run an ultra marathon, right? They're just learning to walk. So make sure that you're going through the proper steps and you're taking the time to learn each step along the way properly from a good source, a good trusted source. So
and
with
let's
that
move
being
on
said,
to
let's get
number
back.
9.
Yeah, let's do it. Now let's get back into it. Number 9 is probably my favorite. It's probably my favorite. I'll be honest. It plays to my strength a little bit, and that's going to be a self burn, but you'll see in about 2 seconds. What's number 9, Chris?
Discipline beats intelligence. In fact, there's some research that shows that the average investor earns typically 4 to 5% annually, while the market returns 9 to 10%. And that's not because the average investor chooses bad investments. It's because they panic sell and they chase trends. It's kind of like in fitness. If you're the person that just eats broccoli and chicken, you're going to be doing pretty good. But if you're the person that goes around from every single new fad diet, well, your diet's going to be all over the place. Your weight's going to be fluctuating consistently or constantly. Wealth is built by staying in the game, not by outsmarting it at every twist and turn.
Discipline is just so key, right? Not just for finance. Obviously, you know this, guys. If you're having trouble with your discipline, I mean, we're all about reading good books here. I would say Extreme Ownership is a great one. What's another good discipline book, Chris? I know wasn't there another one by Jocko? There's Extreme Ownership.
Discipline equals freedom.
Discipline, that's the one I was thinking of. That's a great book. I highly recommend that one, especially if you're really into like Jocko's podcast. It's just, it's a good book. It's a good read. You got to read that one. But no, absolutely. I think what you're saying is just gold. It's very useful. And it's stuff that, if you're not constantly surrounded by the right information to get better, to get stronger, right? This is such a great outlet for you guys. Listening to the podcast, reading these books, right? Bettering yourself, but not just listening, not just studying. You have to put it into practice. So I implore you, please, whatever we're learning this week in your world, please take action. Please, please, please take action. Because as we know, education without action is just entertainment.
First try.
But yeah, but
I think this one's so important that discipline beats intelligence, because what I find is it's typically not a knowledge problem. It's typically that people don't have the information, so they lack the consistency to follow through, because consistency is boring, which is like we learned from number, 5 or 4? Boring is beautiful. Boring is what gets you where you want to go. Boring is the systems. Boring is the discipline. Boring is sticking with it day after day after day until eventually you are where you wanted to be the entire time. With that being said, let's move on to number 10 as we close out on today's podcast. And this one's really important. And if you've listened to the podcast before, you've heard this over and over and over again. And that's personal finance is personal. You might be comfortable with risk and investing in stocks. Someone else might sleep better with having more cash. Different people are different people, and everyone has their own thing that works for them. And to make a wide-ranging blanket statement of you need to do this with your money is not the way to go in life, because everyone has different situations, different outcomes, different places in life. And that's why we at the Fi Guys, we hate making blanket statements of this is the way that everyone should do things, just the way that you will do things. I like to say this is the way people ought to do things. If you want something, this is the way you ought to do it. But that does not mean that's the way you should do it or have to do it. This is the way that if you want to be successful, this is the way people have done it. And there are other ways that you have to be open to that can work for other people too. Risk tolerance, debt tolerance, income variability, they're all personal. So to screw a one-size-fits-all advice, you have to build a plan that fits your life specifically. And that takes a lot of knowledge, consistency, and discipline to see it through.
Couldn't agree more, right? And the more time you spend in this space of finance, of personal growth, of building the life that you really want to live, the more knowledge you're going to have to make better decisions and really understand when something is for you or not for you at all. And that's what's so beautiful about being in this space of finance, of fitness, of philosophy, of life. The more time in, hopefully, right? Hopefully, if you're looking for it, the better you are at operating in life, right? That's where wisdom comes into play. That's why when we go to those elder statesmen to ask their opinions, to get their wisdom, right? To get their knowledge, right? So make sure that you're really seeing every information, right? Because information, Chris's financial plan, it's going to be great for him, right? But if you took that and put it onto me, it'd be terrible. It'd be a horrible fit for me, right? Because we're two different people living two different lives, and we're in different stages of our lives. So make sure when someone gives you advice, right, make sure it's for you and your situation, and really analyze it. And what we talk about on this podcast is if you're going to do anything, well, there's a lot of things you're going to want to do, but one of the things you should be doing is questioning everything, right? Questioning, is this for me? Is this in my best interest? Is this a great idea? Is this a good idea? Is this person trying to get something out of it? Right? Here at the Fi Guys, we don't get anything. We don't get like, one view equals $1. Like we don't have a course. We don't have a subscription. Like we're just doing it because we love to teach, we love to inspire, we love finance, and it's such a great way to get better at finance, right? They say, I forget the exact quote, Chris, and I'm sure my quote machine will pop up real quick, but you can learn it, and then once you're able to teach it, that's like the final echelon of the knowledge, correct, Chris?
Yeah, it's something like that.
Something
but yeah,
like that.
as you learn to, if you can teach, you can often do.
So that was number 10. Now, if you can guess, I don't think you can, but hey, maybe you can. Can you guys guess what number 11 is? If you're listening in the car, if you're on your way to work, if you're on your way to school, what would number 11 be? Could you figure it out? If you have an idea what it could be, I would love to hear it in the comments, because chances are it's not it, but it's one we can maybe talk about on a different podcast. So for number 11, our final one for today's episode, start now, not when you feel ready. Start now, not when you feel ready. That's a tough one. That's a tough one sometimes. You get scared to jump in the water, get a little bit panicked, and you end up backing out. So Chris, tell us about this one. How can we benefit from starting today rather than tomorrow?
Well, just by having the information, knowing that starting investing at 25 rather than 35 is often hundreds of thousands of dollars in your retirement account. Hundreds of thousands of dollars that get you closer to the place that you want to be. Hundreds of thousands of dollars of less stress, of less concern of running out of money in retirement. We said that quote earlier, but the best time to plant a tree was 20 years ago. But the second best time is today. It's right now. You don't have to have the perfect plan or the perfect strategy to start, but you do need to start. You do need to get moving. If you are sitting around waiting till everything falls in line, till everything is perfect before you start investing, once I have my next job, once I get the next promotion, once I get to my next house, once my kids are out of this next school, then I'll start investing. All of those things are just excuses. Excuses to not take control of your life. Excuses to not be the person that you want to be. Too many people go through life hoping that money is going to change. Their relationship with money will change. Money does not have the propensity to change. Money just is what it is. You are the one that creates your relationship with money. Oftentimes when I look at people and their relationship with money, I see the relationship they have with themselves. If your relationship with money is awful, if it's fraught, if it's filled with this need to fight and gain more in order just to hoard it or to push it all away, that's the exact same thing you have with yourself. And oftentimes you look at someone's relationship with money, you can see the exact same thing come up with the relationship with their partners, with their parents, over and over and over again. Because ultimately what it is, it's the relationship you have with yourself. And if you want to get better with who you are today, don't wait. You have to get started today. Getting better for yourself personally, physically, emotionally, mentally, spiritually, and financially. It all works together. Here at the Fi Guys, we use money as a jumping off point to try to actually teach you guys something substantially larger than just money. Money is just the byproduct of living a great life. It does not mean that in order to have money, in order to live a good life, you have to have money. Money just facilitates whatever it is that you want to do in order to have a good life.
I love that. That's so perfect. That's so perfect. Like we said, money is not the scoreboard. Money is a tool. And with that being said, we request that you guys recite all 11 right now in the comment section without looking and going back in the podcast. Just a joke, but I hope you were taking notes. I hope you might have a favorite one that you picked out that you're like, hey, that one kind of speaks to me, right? And if you did, maybe share it with a friend. Maybe share it in the comments, right? We'd love to hear your guys' feedback on which one really spoke to you. And that helps us get better, right? As podcasters, as teachers, as just people in general, right? But we do have an action step, right, Chris? We always have an action step. What would this week's action step be?
If you've been waiting to feel like you're quote unquote smart enough to invest, you don't have to. These rules are a green light. So I want you to start small, stay consistent, and don't overthink it. If you want to get better in finance, you need to start today. A little bit better every day. I'm not asking you to go from where you are currently to Warren Buffett. I'm not asking you to go from where you are right now to Jeff Bezos, Mark Zuckerberg, Elon Musk. I'm asking for 1% better. Anyone can be 1% better. And if 1% better seems like too big of a chasm to jump, 0.5% better, 0.25% better. just be a little bit better tomorrow or today than you were yesterday. If you stack that up over and over and over again, you will get where you want to be. It might not be the place that you hoped you would be, but you will be in a better place than you are today.
That's beautiful. Well, guys, that's going to do it for us on our Monday episode. Feel free to come back on Wednesday and on Friday. Just a heads up, on Wednesday, we post the viewer mailbag all by itself over there on YouTube if you are looking for that. But we do post our Friday episode on every platform you can listen to podcasts on. So if you aren't subscribed, hit that button. If you aren't following, hit that button. If you haven't liked, what are you doing, guys? What are you doing with your life? But most importantly, if you're not going to do any of those, feel free to share the podcast with someone who you believe deserves to be financially free. None of us want you to stress about money, and this helps, right? So with that being said, that's going to do it for us here at the Fi Guys. I'm Dom, he's Chris, and we will see you back here on Friday for a recap and a fun viewer mailbag we got planned. So see you guys soon and have a great week. Later, guys.
Later.
This video podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the hosts and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.